All right, let's just jump right in. Selling a property, it seems pretty straightforward, doesn't it? You find a buyer, you settle on a price, you get the check. Easy. But, and this is a big but, there are these hidden tax traps kind of lurking in the shadows that can get super costly real fast. They can turn a great sale into a total headache. So today, we're going to unpack the biggest mistakes you'll want to avoid.
And no, I'm not exaggerating. Seriously, just picture this. You sell your house, you're thinking, great, this profit is tax-free, and then bam, a letter from the IRS shows up with a bill for tens, maybe even hundreds of thousands of dollars. It sounds crazy, but it happens all the time. And it usually kicks off with one tiny, easy-to-miss piece of paper.
So we're going to break down 4 common scenarios where people really get tripped up. We're talking about selling your main home, doing one of those 1031 exchanges for investment properties, the surprises that come with selling a rental, and of course, the classic house flip. Trust me, each one has its own special little trap. Okay, first up, let's talk about the one that affects most people. Selling the house you actually live in. You'd think this would be the easiest one, right? No complications, but that's exactly why so many people fall right into this paperwork trap. Yeah, so most of us have heard about this rule, the primary residence exclusion, and it's a great rule. You can make up to 250 grand in profit tax-free if you're single, or a massive $500,000 if you're married. The problem is, this awesome rule gives people a false sense of security. They just think, hey, my profit's way under the limit, I don't have to do a thing. Well, here's the catch. When you close the sale, you might get a little tax form in the mail called a 1099-S. And if you get one, you can bet the IRS gets one too. And the second that form is issued, it triggers a requirement that is absolutely not optional. You have to report the sale on your tax return. Even, and this is the key part, even if you owe 0 tax on it. And this is why it's so important. If you just toss that 1099-S aside and ignore it, the IRS's automated system sees the full sale price. Let's say it's $600,000, but it has no idea what you paid for the house. So what does it do? It assumes the entire 600 grand is pure profit, and what you get in the mail is a heart-stopping and totally wrong tax bounce. So the takeaway here is super simple. If you get a 1099-S, you just report the sale. That's it. You show what you bought it for, what you sold it for, and then you check the box for the exclusion to show the IRS you owe nothing. It's one little step on your tax return that saves you from a monster of a headache. All right, let's move on to the next trap, which has a whole different set of really strict rules. Okay, next up, the 1031 exchange. Now, this is an incredible tool for real estate investors, super powerful. But all that power comes with some very strict rules. And the biggest one, the one that trips everyone up, is what I like to call the hands-off rule. So, just as a quick refresher, what is a 1031 exchange? Basically, it lets you sell an investment property and then roll all that money directly into a new one without paying any capital gains tax on the sale right now. You're basically kicking the tax can down the road. It's an amazing strategy, but you've got to get it exactly right. Now, the number one rule is that you can't just sell the property, get the check, and then go buy a new place. Doesn't work that way. You are legally required to use what's called a qualified intermediary. This is a third-party company that holds onto your money from the sale, and then they're the ones who use those funds to buy the new property for you. And listen, I really can't say this strongly enough. If that money from the sale touches your bank account, I mean, for even 1 second, the whole 1031 exchange is blown. It's over. It's disqualified. And your entire profit from that sale is now taxable immediately. That hands-off rule is not a suggestion, it's absolute. All right, let's shift gears to our third big trap. And this one catches so many rental property owners completely off guard. I call it the phantom gain, because you can end up owing a ton of tax on a profit you never even felt like you made. I mean, think about this. Let's say you bought a rental for 300 grand. You rent it out for 10 years, and then you sell it for exactly 300 grand. You broke even, right? So no profit, no tax. Simple. Nope. Wrong. This is where this tricky thing called depreciation recapture rears its ugly head. So what in the world is going on? Well, every single year you own that rental property, the IRS lets you take a deduction for the building's wear and tear. It's called depreciation. It's a nice little tax break that lowers your income each year. But the IRS doesn't just give you that benefit for free. When you finally sell the place, they come back to recapture it. Let's just run the numbers real quick. You bought the place for $300,000. Over 10 years, let's say you took a total of $100,000 in those depreciation deductions. The IRS now says your official cost, your adjusted cost basis, is only $200,000. So when you sell for $300,000, in the eyes of the IRS, you just made a $100,000 profit. That is your phantom gain. And here's the kicker. That $100,000 gain isn't taxed at the lower capital gains rates, the 15 or 20%. Nope. This specific type of gain gets hit with a special higher tax rate of 25%. Yeah, a very, very expensive surprise. Okay, our last trap is for all you house flippers out there. And the mistake here all boils down to one simple but crucial question. What is a flip in the eyes of the IRS? Is it an investment or is it a business? See, the IRS looks at this in two totally different ways. An investment is something you buy and hold for the long term, hoping it goes up in value. But a flip? That's a business. Your whole goal is to buy it, fix it up, and sell it quick for a profit. And let me tell you, the IRS taxes a business very differently than an investment. This is probably the best way to think about it. If you're a flipper, that house isn't just an asset, it's your inventory. Seriously, just like cars are inventory for a car dealership, those houses are the products your business sells. So here's the bottom line. The profit you make from a flip is not a capital gain. It is business income. That means it gets taxed at your normal, higher income tax rate. And on top of that, you also have to pay self-employment taxes on it. The total tax hit can be way, way higher than most new flippers ever see coming. Okay, so let's do a super quick recap of these 4 big traps. 1. Selling your main home. If you get a 1099-S, you have to report it. 2. Doing a 131 exchange. Use an intermediary and don't you dare touch that cash. 3. Selling a rental. Remember that depreciation creates a taxable gain. And 4. Flipping a house. It's a business and it's taxed like one at higher rates. And that really brings it all back to the one huge question you have to ask yourself before you ever sell. How does the IRS see this? Are you selling a home, an investment, or a business product? Because their answer to that question changes absolutely everything. And knowing that answer before you put that sign in the yard, that's the real key to staying out of trouble.